So imagine you're flipping a coin and you guess the outcome perfectly, like nearly 80% of the time.
That is an absolute hot streak.
Right. You are calling heads or tails with just uncanny precision. You walk away from the table feeling like a total mastermind, only to check your pockets and realize you were completely broke. You somehow lost money.
Which just creates this immediate cognitive dissonance. I mean, we are so conditioned to believe that a high success rate mathematically guarantees a positive net outcome.
Yeah, exactly.
The human brain just loves the comfort of a high batting average, and we rarely stop to examine the actual weight of the misses.
And that blind spot is exactly what we are jumping into today. We've got our hands on a really fascinating set of performance logs from August 4th, 2026.
And just to clarify, this isn't human performance data we're looking at.
No, not at all. We are looking at an automated AI trading fleet. So 5 different algorithmic bots deployed into the live market. They closed 13 trades that day, and they won 10 of them.
Which is a 76.9% win rate.
Huge. But the punchline, the entire fleet ended the day in the red. Okay, let's unpack this. Because today, for this deep dive, we aren't just reading a spreadsheet of trading statistics for you.
Right, there's a much bigger lesson here.
Exactly. We are exploring the critical difference between predicting an isolated outcome and the much more complex art of knowing exactly when to quit.
Yeah, and the source material anchoring our discussion today comes from the performance notes of those 5 specific MT5 bots.
And for anyone who doesn't know, MT5 is basically the industry standard, right?
Yeah, MT5, or MetaTrader 5, is essentially the central nervous system for retail algorithmic trading. It's the platform that actually executes the buys and sells.
Okay, got it.
And the overarching theme running through these daily logs serves as a brilliant cautionary tale for anyone building autonomous systems. It demonstrates, with cold, empirical data, how an incredibly high win rate can serve as a smokescreen.
A smokescreen that completely masks a fatal structural flaw in how a system exits its positions. So let's start with the macro view, because the math here is just wild. How does a system win 10 out of 13 times and still end up losing money?
Well, if we look at the raw aggregated numbers for the fleet on August 4th, the gross profit from the 10 winning trades was 626 yen.
Okay.
But the gross loss from the 3 losing trades was 624 yen.
Wow. Okay, so that leaves you balancing on a razor's edge.
Exactly. Before any underlying market mechanics are even factored in, the fleet has a gross positive result of a mere 2 yen. You have 10 victories, 3 defeats, and literally 2 yen to show for the effort.
But then the hidden mechanics of the market kick in, because the fleet gets hit with an 18 yen swap fee.
Right, the swap fee.
And for anyone not elbow deep in Forex trading, a swap fee is basically the cost of doing business overnight. It's the interest rate differential you either pay or earn for holding a currency position past the daily rollover point.
Which in this instance, holding those trades open cost the fleet 18 yen.
That instantly vaporizes the 2 yen gross profit. It drags the realized result for the entire day down to negative 16 yen.
And that negative 16 yen is just the realized result, meaning it only accounts for the trades that were officially closed and settled.
Oh, right. There's more.
Yeah, the MT5 logs reveal a much more concerning underlying metric. At the end of the trading session, the AI fleet was still carrying an additional 201 yen in open, floating losses.
Ouch.
The risk hadn't been neutralized at all. It was just sitting on the books, quietly bleeding equity.
And this all boils down to a single devastating metric, which is the payoff ratio. The average winner for this AI fleet was just 62.6 yen.
Right.
But the average loser was a massive 208 yen. That creates a combined payoff ratio of just 0.30. I mean, for every dollar, or in this case, yen they risked, they were only making 30 cents back.
What's fascinating here is that the structural failure had absolutely nothing to do with finding valid setups.
Yeah.
I mean, if an AI model wins 10 out of 13 times, its entry logic is highly effective.
Right, it's finding the signal and the noise perfectly.
It is. The fatal flaw is entirely related to the size and shape of the losses. The autonomous models were aggressively cutting their winners short at the first sign of profit, while passively letting their losers run totally unchecked.
It's like a football team that successfully executes 10 incredibly precise, highly strategic 5-yard plays.
Marching right down the field.
Exactly. The crowd is going wild, the quarterback's completion percentage looks Hall of Fame bound. But then the whole system breaks down. They give up 3 massive 60-yard interceptions.
Yeah.
The scoreboard at the end of the game doesn't care about your completion percentage. It only cares about the total yardage. But what I really want to understand is the mechanism behind the mistake. The AI executing the 5-yard plays is clearly functioning, so why does it suddenly take a 60-yard sack?
Well, to understand that mechanism, we have to stop treating the fleet as a single entity and actually look at the behavioral profiles of the individual bots.
Okay, let's do it.
An average payoff ratio of 0.30 is usually dragged down by specific systemic behavioral errors. And we see two distinct themes in the logs here: the illusion of action and the paralysis of symmetrical logic.
Okay, let's tackle the illusion of action first, because the log for the BoundSniper bot is a perfect illustration of this.
It really is.
BoundSniper won 4 out of 5 of its closed trades on August 4th. That's an 80% win rate. But the wins were microscopic. We're talking 31 yen, 8 yen, 10 yen, and 7 yen.
It's a classic strategy of picking up pennies in front of the steamroller.
And the steamroller definitely didn't miss. BoundSniper absorbed one single 263 yen loss. And the logs show this loss was actually inherited, like it was carried over from before August 4th.
Right.
When you factor in the swap fees for holding that toxic position so long, BoundSniper ended the day with a net loss of 225 yen. It generated a payoff ratio of 0.05. But my question is, if this bot is automated, why didn't it just close the bad trade days ago?
Well, because BoundSniper doesn't actually possess a brain in the traditional AI sense. The source notes detail that it receives its signals via a TradingView webhook.
A webhook.
Yeah, a webhook is essentially a digital tripwire. A completely separate upstream strategy hosted on the TradingView platform analyzes the market. When it sees a setup, it fires a tiny automated text message, the webhook, over to the MT5 platform that basically just says BUINW.
Oh, I see.
So BoundSniper just acts as the hands, executing the order blindly.
So the MT5 bot is really just a middleman following orders. It doesn't know why it's buying, it just knows it was told to.
Precisely. The failure here isn't necessarily the MT5 bot itself, but the disconnect between the upstream brain and the downstream hands.
Makes sense.
If the upstream strategy lacks a mechanism to send an equally urgent abort webhook when the market turns against it, the executing bot just sits there holding a deteriorating asset. It's an architectural flaw in how this system manages inherited risk.
Okay, I get that. If a bot is just blindly following a webhook, it's obviously going to get crushed when the overarching strategy fails. So what does this all mean for the bots in the fleet that do have their own built-in brains, the ones actively analyzing data?
That brings us to ML Score Analyst.
Right, which relies on a machine learning model called CatBoost.
Yeah, CatBoost is a highly sophisticated gradient boosting algorithm. In simple terms, it builds decision trees. It ingests massive amounts of historical market data, looks at current conditions, and categorizes them.
So it's doing heavy lifting.
It is. It might say, based on these 50 technical indicators, this setup belongs in the high probability of going up category, and it triggers an entry.
But the results for ML Score Analyst on August 4th were bizarre. It had an almost perfect numerical cancellation. Like, it recorded one win for 303 yen and then immediately absorbed a loss of 304 yen.
Yeah, a near-perfect mirror.
Plus, it carried a 90 yen floating loss at the end of the day. They basically zeroed each other out. If CatBoost is so sophisticated at categorizing data, why is the output essentially a coin flip?
Because CatBoost is acting purely as an entry scorer here. The logs demonstrate a classic case of symmetrical exit logic.
Symmetrical logic. Okay, break that down for me.
Symmetrical logic means the system is programmed to treat risk and reward identically. It will hold a trade until it reaches, say, a 300 yen profit target, but it will also passively allow a bad trade to hit a 300 yen stop loss.
So even though the AI is brilliant at finding the exact moment to enter a trade, it fundamentally lacks the dynamic intelligence to manage the trade once it's actually live.
That's the paralysis. Scoring a brilliant entry creates absolutely zero positive expectancy if your exit distribution is entirely symmetrical.
Right, because it's just a 1-to-1 ratio at that point.
Exactly. If your AI doesn't know how to protect a 150 yen gain when the market momentum suddenly shifts, or cut a failure at 50 yen before it reaches the maximum stop loss, you don't actually have a statistical edge. You just have a very mathematically complex way of gambling.
Wow. Okay, so we've dissected the structural flaws. We've seen how disconnected webhooks and symmetrical CatBoost models bleed money. But to be fair to this AI fleet, there were moments of success on August 4th.
There were.
And this is where I think we pivot to the most crucial part of this deep dive. When an AI bot actually makes money, do we know how it achieved that?
That is arguably the most important question in algorithmic systems today, the transparency of the black box. We can look at the GateGrid AI bot for an example. It won 2 out of 2 trades for a total gain of 99 yen.
And what stands out in the logs is how it secured that win. It didn't just hit a random target, it smartly closed 2 separate grid legs simultaneously at exactly 17.12, which left the account totally flat with 0 open risk.
And to understand why that is significant, we need to understand what a grid leg actually is.
Okay, yeah, let's explain that.
A grid strategy doesn't just place one trade. It lays down a net of buy and sell orders at fixed price intervals above and below the current market price.
Yeah.
Each individual order is a leg.
So it's casting a wide net.
Right. The idea is to catch natural market volatility. As the price zigzags, it triggers these legs, accumulating small profits over time.
But the danger of a grid is if the market suddenly trends hard in one direction, right? You end up triggering all these legs in the wrong direction, and you accumulate a massive, heavy bag of losing trades.
Exactly. The fact that GateGrid AI closed 2 legs simultaneously means it likely recognized that the ranging environment was ending. It netted the positions against each other, perhaps taking a small loss on one leg but a larger profit on the other, to neutralize the entire grid and flatten the risk.
That's pretty smart.
From a mechanical standpoint, it did exactly what it was supposed to do.
We see a similarly contained profile with MAribbonTrader too. It had the most balanced risk profile of the day. 2 wins for a total of 118 yen and 1 contained loss of just 57 yen.
Which generated a positive payoff ratio of 1.04.
It was the only bot that actively kept its losing trades significantly smaller than its winning trades.
Which is the holy grail of risk management. But the source notes highlight a massive glaring blind spot in evaluating these successes.
Right.
The MT5 report we are reading is essentially just a cash register receipt. It tells us the timestamp of when the trade closed and the price at which it was executed.
So it tells us what happened, but completely obscures the mechanism of why it happened.
Exactly. The problem is the missing Llama logs. Llama is a framework that allows you to run large language models locally on your own machine.
Okay.
For a bot like MAribbonTrader, the MT5 platform is just the execution terminal. The actual brain is the local Llama instance generating text commands based on market data. But the MT5 receipt does not show us the Llama log. It doesn't show us the LLM's internal confidence rating at the moment of exit.
It's like a student handing in a flawless calculus exam, but they didn't submit any of their scratch paper.
That's a perfect analogy.
Like, the final answer is correct, but we have absolutely no way of knowing if the student actually understands the underlying theorems or if they just got incredibly lucky and guessed the right number. We need that decision trace.
Without the decision trace, we simply can't answer the most critical question. Did the LLM actively analyze the live chart, recognize a shift in market structure, and consciously change its internal command from hold to close?
Whoa.
Or did the MT5 platform just trigger a hard-coded static trailing stop loss that a human programmer put in as a safety net?
Wait, if the system has a hard-coded stop loss that saves the account, isn't that a good thing? Like, why does it matter if the AI decided it or the safety net caught it?
Because if it hit a hard-coded stop, the AI model didn't actually make an intelligent decision. It was merely rescued by a rigid parameter. The entire point of integrating large language models into trading isn't to build better guardrails. It's to build a system that can change its mind.
Oh, wow. I didn't think about it like that.
We need the system to admit it was wrong and proactively pivot. Until you can match the exact close timestamp on the MT5 receipt with a generated Llama response saying, confidence dropping, executing exit, giving the AI credit for being smart is premature.
Okay, so a valid exit requires transparent reasoning. We need to see the internal scratch paper. But here's where it gets really interesting. What happens immediately after the AI executes a brilliant, well-reasoned exit?
Oh, yeah. This part is fascinating.
Because the source logs highlight a scenario that is almost comical. A bot makes a fantastic decision to protect capital and then instantly ruins it. We have to talk about the bias of reentry.
It's a classic psychological trap. We see it constantly in human behavior, and the log suggests we are successfully programming it into our machines.
The prime example here is the MAribbonTrader bot. The sequence of events for this bot is just wild. MAribbonTrader successfully closes a long position on the British pound to Canadian dollar pair. It secures a 50 yen gain by utilizing a protective stop positioned above its entry price. It locked in the profit. It executed a textbook, flawless exit.
But the MT5 logs show that a mere 10 minutes later, MAribbonTrader opened another long position in the exact same direction on the exact same currency pair.
And it ended the reporting period carrying a 111 yen floating loss on that new impulsive trade. It jumped right back into the fire.
It really did.
It recognized the danger, got out safely, stood on the sidewalk for 10 minutes, and then just walked right back into the burning building. It makes you wonder, is the AI's wait command strong enough to override its initial bias?
This raises an important question about how the underlying AI in MAribbonTrader processes information, because this bot uses the Quinn model, which is a multimodal vision language AI.
Multimodal meaning it sees things.
Exactly. It doesn't just read spreadsheets of numbers, it actually processes visual data. The bot takes screenshots of the charts, complete with moving average ribbons, support lines, and price channels, and feeds those images into Quinn.
So the AI is literally analyzing a picture of the market the exact same way a human technical analyst would stare at a monitor. It's translating pixels into semantic context.
Yes, but the mechanism of how it interprets that visual context window is where the flaw lies. Think of it like a weather radar.
Okay.
If you look at a static image of a massive storm cell from 10 minutes ago, your conclusion is obviously take shelter.
Sure.
But if you watch the live animated loop, you can see the storm cell is actively breaking apart and moving away.
Ah, I see. So when MAribbonTrader feeds Quinn a new screenshot 10 minutes after exiting, the overall visual structure of the chart, the moving averages, the broad trend lines, probably hasn't changed that much.
Exactly.
The AI is looking at the static image, seeing the same bullish setup it liked an hour ago, and just concludes, hey, this still looks like a buy.
Right. It struggles to differentiate between a genuinely fresh, high-probability opportunity and the deteriorating remnants of the structure it literally just exited. The initial 50 yen profit proves the system is capable of executing an exit to protect capital.
But that immediate re-entry tests whether the system possesses any concept of patience.
Can the wait command function when the visual bias remains overwhelmingly the same? That's the real test.
It highlights how incredibly difficult it is to code patience. Like, doing nothing is an active strategic choice, but algorithmic systems are fundamentally biased toward action.
The system just assumes that if it's connected to the market, it should be interacting with it. It lacks the higher-level contextual awareness to realize that sometimes the absolute most profitable action is to simply observe.
So let's pull all of this together. The lessons embedded in this August 4th snapshot extend far beyond the niche world of automated forex trading. We started by looking at a fleet that boasted a nearly 77% win rate. They correctly predicted the immediate future 10 times out of 13. Predicting the outcome, finding the entries, was never the bottleneck.
No, the models are highly adept at identifying the signal. They absolutely know how to start the process.
But the true benchmark of an autonomous system, and honestly, the true test of human decision-making in project management, in business investments, and in life, is recognizing when a valid idea has expired.
Yes, knowing when to fold.
A high win rate is fundamentally useless if you lack the mechanism to cut your losses. You can hit 105-yard passes, but if you don't know how to throw the ball away when the pocket collapses, you are going to lose the game.
And if we connect this to the broader trajectory of artificial intelligence, the data points to something more profound. The large language models driving these autonomous agents models like Quinn or the ones running locally on Llama are trained on unfathomably massive data sets of human behavior, human text, and human logic.
Right, they're essentially mirrors of our own cognitive processes.
Which means we have to critically examine the training data. If these autonomous bots are struggling with the exact same behavioral pitfalls as human traders, stubbornly holding on to losing hands, jumping impulsively back into trades because they can't let go of an initial bias, failing to adapt when the context shifts, we're left with a sobering reality.
What's that?
We are inadvertently programming our own emotional sunk cost fallacies and cognitive biases into systems that are supposed to be governed by cold, hard algorithmic logic.
Wow. We set out to build a perfectly rational, unemotional calculator, but because we fed it our own data, it learned how to be stubborn. It learned how to hold a grudge against the market.
We expect these models to be ruthless with their payoff ratios, but the architecture reveals they might be just as hesitant to admit defeat as the average person. We haven't eliminated human error, we've just automated it at a higher speed.
What a wild thought to leave off on. The ultimate flaw in artificial intelligence might just be how perfectly it mimics our own inability to walk away. Thank you for joining us on this deep dive into the MT5 logs. As you move through your own projects this week, take a moment to evaluate your own payoff ratios. Where in your life are you racking up small, comforting wins only to let one massive, stubborn loss wipe out all your progress? Where do you need to actively deploy your own wait command? Until next time, keep questioning the mechanisms behind the numbers, and remember, guessing the coin flip correctly 77% of the time doesn't matter if you don't know when to leave the casino.